Hello, hello. My top dividend growth stock this month is so strong that I decided I wanted to go in depth on it rather than list out my top 10 sort of rapid fire like I normally do. This stock has a 43 out of 45 points in my scoring system, is 5 out of 5 stars on Morningstar, outperform according to Credit Suisse and Reuters, 4 stars from CFRA, and a buy from Argus. Across the board, this stock looks really, really juicy. This is a bear market bargain that you should be taking a look at. Without making you wait too long for the reveal, we're going to be diving into Comcast today, ticker CMCSA, and showing you why it's worthy of serious consideration and why I'm going overweight on it in my portfolio. I know what you're thinking. I know. We'll get through it together. Comcast is looking really good. And before we get into the analysis, if you could take just a couple seconds to like and subscribe, it would really, really help the channel out. I would appreciate it so much. So first, let's take a look at what Comcast is, because I think most people just think of it as the internet provider with a poor customer service record. But there's a whole lot more to it than that. Their core cable business makes up a bit over half of their revenue, and this segment's expected to continue growing, but at a pretty modest rate. However, they own a number of other assets. One of those is NBC Universal, which includes theme parks, so Universal Studios, as well as a number of iconic brands like Jurassic Park and Despicable Me. They have the rights to the Olympics and NFL games. And they also own a variety of different channels like E!, CNBC, MSNBC, and a whole bunch more. Beyond that, they also own Sky, which is the largest paid TV provider in the UK with over 13 million subscribers. And Sky has rights to the English Premier League soccer games, which is the biggest and best soccer league in the world. It's a really nice asset. The company also has potential upside in the Peacock streaming service, while not being as dependent on it for growth and success as some of their other competitors. And what I mean by that is Netflix, their streaming app has to be successful for Netflix to be successful. It has to grow for Netflix to grow. And Comcast has Peacock, which is a lot of upside for them, but if it doesn't do that great or it doesn't become the dominant streaming service in the marketplace, that's totally fine for them. They have a diverse stream of revenue. So next, let's look at my scoring system and see how Comcast shakes out from a quantitative standpoint. First up, let's dig into the quality side. Their value line safety score is a 1. That's the highest score you can get and is good for 5 out of 5 points. Next up, we look at the value line finance score. This is an A+. That's the second highest score, with A++ being the highest, so that's good for 4 out of 5 points. These two value line scores together take a look at things like their balance sheet, their debt, like how stable is the business, how well managed is it from a financial standpoint, and how safe is it, risk of bankruptcy, that sort of thing. And Comcast is looking really good. Next, we look at their Simply Safe dividend score. This is another analysis tool that I use for dividend growth investing. They assign a safety score to most large dividend paying stocks and try to analyze how safe is that dividend in the event of a recession. What are they going to do? They assign a score of 89, which is the top bucket, which is very safe, and that's good for 5 out of 5 points. Next, we'll look at their moat rating assigned from Morningstar. They get a wide moat, which is the best score, and is good for 5 out of 5 points. And lastly, we look at their Chowder-ish score. So what this is their 5-year dividend growth rate, plus their forward dividend yield, plus their buyback yield, but we cap the buyback yield at 3, and the reason behind that is while dividends tend to be stable year to year, usually slowly growing, buybacks can be bunched up, like you can do a lot in 1 year and then not much the next year or none. And so I cap it at 3 to try to not give too much credit to one good year of buybacks. And here they come in with an 18.68, which is good for 4 out of 5 points. My threshold for 5 out of 5 there is 20, and they come up just a tad short. But so far, the quality is looking really solid. So next, let's take a look at their dividend growth history. This screenshot is from Simply Safe Dividends that shows that their most recent raise was of 8% in January of this year. Their average over the last 5 years has been 13% a year and 16% a year over the last decade. So pretty solid dividend growth all around. They've raised their dividend consecutively for 13 years. So they're looking really great. They're not yet a dividend aristocrat, but they're certainly looking on track to be a dividend aristocrat of the future. This is something I like in a long-term potential hold because people start paying a lot of attention once you get to that 25-year mark. I plan on holding this for more than 12 years, so I think you'll see a bump in price as it hits different thresholds of the number of years they continue that streak for, and it'll get adopted into more index funds, more investors will take a look at it as that streak gets longer. So getting in early can be really helpful. Next, let's take a look at their dividend safety. Again, from Simply Safe Dividends. So their payout ratio and forward payout ratio, very low, 31 and 29% respectively. That gives them a lot of room to continue growing that dividend for the foreseeable future. The next two things we'll look at are debt, net debt to EBITDA, and net debt to capital, low and edging high, respectively. A lot of that debt comes from acquisitions like the NBC Universal acquisition, but it's not unmanageable for them. They have a lot of cash flow and a lot of growth, so nothing too worrisome here. And Simply Safe Dividends is certainly not worried about it. Neither is Value Line, so I'm not too worried about it either. Again, we saw that 13-year dividend growth streak. What I find really interesting here is they sort of started paying that dividend right around the 2008 recession, and they increased it throughout. In fact, they're actually one of the few companies that grew their sales during the recession, even though their stock fell more than half during that time period. So they tend to perform really, really well. One area when they don't perform as well was the COVID lockdown, because they lost out on things like their theme park revenue. But they're a pretty well diversified company. The dividend looks safe. The ability to grow it going forward looks safe. It's really, really appealing to me. So now that quality stuff looks good, let's take a look at my price scores. The first one is dividend yield theory, which it compares their forward dividend yield against their 5-year average dividend yield. This theory suggests that a dividend will revert to its mean over time. And so that says there's about 35% upside in the price. If the price were to go up such that the dividend yield came down to its 5-year average, the stock would go up about 35%, which is exciting. Next, we'll look at a dividend discount model where we'll try to value the company based on the present value of all future dividend payments. That suggests 29% upside. Both of those are 5 out of 5 points. Third thing we'll look at is Morningstar. So we'll use Morningstar's independent analysis to say how good of a bargain is this. They say it's a 5 out of 5 stars, which gives 5 out of 5 points. And lastly, we'll look at the PEGI ratio. So that's price to earnings over projected growth plus shareholder yield, which is the dividend yield plus the buybacks capped at 3, similar to that Chowder-ish score. And that's a 0.52, which is a really excellent score and good for another 5 out of 5 points. So looking at our recap, we got 23 out of a possible 25 of the quality points, which is really, really solid. It's right up there as the highest I've seen. And what is not improvable upon is their price score. It's 20 out of 20. They took full points across a variety of different ways of valuing the company. So we've got a wonderful company at a very, very wonderful price. Not only are they doing great in my scoring system, but CFRA, one analysis firm, has a 12-month price target of 55%, representing about a 30% upside. Morningstar pegs the fair value at $60, representing about 50% upside. Insider activity, so people at the company who are high up, their activity looks favorable, meaning they're buying back shares rather than selling them off. They think the company's a good deal and they're loading up. And lastly, one thing to note is that the debt is edging a little bit high, but it's certainly not unmanageable. Value Line's an independent firm. They don't really think so. Simply Safe Dividends doesn't think so. Looking at it, I don't think so either. I think this company is projected to grow EPS at a high single-digit to low double-digit rates over the next few years. It is already undervalued for what it's doing today. So, from my opinion, this is just sort of the best of all worlds. You're getting a growing dividend, a safe dividend, a growing business, so just growing cash flow, safe cash flow, a diversified company, not just in terms of its types of revenue, but it's also diversified in countries, right? They own Sky in Europe. You're buying it at a steep discount, giving you a great margin of safety. It's really exciting. There's a lot of good stocks on my watch list right now, a lot of good companies. There's a lot of stuff where the price has become really interesting with the 2022 market so far. But this one is such a unique opportunity, in my opinion. It seems like such a no-brainer to buy and hold for a long, long, long time. And I am going to be loading up on this rather than spreading my dollar cost averaging money out across a variety of stocks for a while, because I really want to build up a position here before the market decides to revalue this at something a little more appropriate to how great the company is. thanks so much for watching. If you made it this far, please make sure you liked and subscribed. It really helps more than you know. And check out some of my other videos if you can. Let me know in the comments what your top stocks are. If you're really excited about something that an opportunity that got created in this market, I'd really love to hear. And if there's anything you'd like to see us analyze in the future. Have a good one. We'll see you next time.